Okay, can everyone hear me now? There we go. I think we got sound working again. Should be able to hear me now. There we go. Perfect. All right. Apologies for that. Yeah. So everything should be fine now. Okay, so let's get into it. We've got quite a bit to get through now. So what is the bank rate? So I'll quickly go through it again. So it's basically the amount of interest that the central bank pays to commercial banks holding money at the central bank. Now, of course, the higher rate of interest means that there is more money that the central bank is able to pay back itself. Is able to pay to those commercial banks for holding money in the central bank. So when you usually see a higher deposit rate or a higher bank rate, that usually is a positive sign for the economy. The central bank is able to pump more money back in or provide interest or more or higher interest payments to those commercial banks looking for or parking their money away for liquidity for the central bank. Remember, this is excess liquidity, excess liquidity that commercial banks have that they just park away at the central bank. So that's what the bank rate is. Now, so other bits as to why it's important. So of course, high rates usually is to slow down growth or make sure that inflation doesn't get out of hand or growth doesn't get out of hand. And low rates is to support or create growth. So and there's also to try and boost inflation as well. So sometimes you might be in a position where the economy is in a deflationary environment, i.e. where the inflation is below zero in the negatives. And then what you would see is that the central bank will try to cut rates to try and boost growth. But that's not of course, in the current environment, that's not the current scenario that we're expecting to see from any of the central banks as of yet. And also, the other reason why it's important as well, of course, it will affect how banks handle loans, people paying back their mortgages, borrowing credit, and also paying back loans as well. So not only for consumers but also for businesses as well is quite key to understand that's why it's such an important thing when we look at the rate decision for any nation. So this, with the rate decision, that's the highest level the central bank can take action to try and control the amount of money flow going through the economy and also, as said, growth and inflation. So rates, of course, are already back at pre-pandemic levels. And we're also looking at too is that where's the economy at the moment? So the key thing to remember about the economy then is so the unemployment rate is unchanged at 3.8%, with the employment change that we had which represents data 2 months ago, was at 296k versus a prior of 177k. The inflation rate, of course, ticked up to 9.4% versus a prior of 9.1%. Average weekly earnings year on year also ticked down to 6.2% from the prior of 6.8%. And first quarter GDP was unchanged for the final bit of data at 0.8%. And GDP year on year prelim was at 8.7% versus prior of 6.6%. UK services PMI final at 52.6% versus a prior of 53.3%. Okay, so with the GDP data, the prelim for that would have been, the previous would have been 8.7%. But yeah, so if we carry on then, so other bits of data then as well, of course, we had the 25 basis point hike that was taken on the 16th of June, the day after the Federal Reserve took a bigger than expected rate decision of a 75 basis point hike, and the Bank of England took a 25 basis point hike. And then we had the SNB, or the Swiss National Bank before that had decided to go with a 50 basis point hike rather than keeping their rates unchanged. So as everyone else was hiking their rates following the Federal Reserve taking big action or aggressive action, the central bank in the UK didn't really follow suit with the other. They just hiked by 25 basis points. So markets were looking for them to do a 50 basis point hike. That's why the pound had weakened the last time around that we did the rate decision. And we'll go through a bit more on deviations as to how big of the moves were. So the previous Bank of England statement then to be aware of, and some key comments. So you had 6 Bank of England policymakers that voted for a 25 basis point hike, and 3 of them voted for a 50 basis point hike. The Bank of England had also, they said that they see inflation slightly above 11% in October. They said that sterling is particularly weak against the dollar, and they raised bank rate because of robust price pressures, tightness of labor market, and risk pressures have become more persistent. They also see second quarter GDP at minus 0.3% quarter on quarter versus May's estimate of plus 0.1%. They said that they will act forcefully if needed, particularly being alert to signs of more persistent inflationary pressures, which of course we're continuing to see in the UK with 30-year high of in inflation, or inflation being at its 30-year high in the UK. Also, the market reactions then following the previous Bank of England rate decision and the comments and the text that was coming through. You had money markets that trimmed their Bank of England hike bets, and they priced a 50 basis point hike for August increase. So, of course, whenever traders start to price in these rate hike decisions, you'll see that the pound would have seen a move towards the upside, and then any sort of reaction from an expected rate hike when the rate does come out is more or less minimal. You more or less get a very choppy reaction on the first candle. So it's more or less, buying the rumor and selling the news. That's how the markets react when they're pricing in the next upcoming meeting. It's only when there is a surprise in the rate decision, whether it's higher than the expected or lower than the expectation, that's when you see more volatility, and that's where it becomes a bigger trading opportunity. And not to say that even when the rate hike comes in as expected, that it's not. But of course, that's left down to you. But you see more volatility when the rate hike comes in unexpectedly higher or lower than what the forecast was. So that's just something just to be aware of and be prepared for. All right, so carrying on then. So you had traders that lifted their BV rate hike bets, and they priced 3% bank rate by the year end. The MPC also stated that it will provide an update on its strategy for gilt sales at its August meeting. Bailey stated the pace of balance sheet runoff, including redemptions, will be between £50 billion to £100 billion in the first year. A confirmation on the vote on whether to begin sales might occur in September, which could then, of course, allow them to begin shortly thereafter. So the gilt sales is, it is an important part of quantitative easing that the Bank of England provides. Of course, the rate decision is the strongest tool that they have. But if they decide to, at this meeting, say that they already start to cut down on already start their balance sheet runoff today, before September is when they're kind of expected to, then that could add some further upward pressure to the pound. So remember, think of it the same way with the Federal Reserve. When they have their asset purchases and they decide to, start reducing the asset purchases sooner rather than later, or rather than as expected, that usually creates a stronger currency because there's less support being provided to the economy that is expected to be quite strong and hold up. So there's more confidence in that country, and hence you get people investing more into that currency as well. Right. So that was the previous statement there. Now throughout July, we had various comments from Bank of England's Governor Bailey. So one of those comments, he said that the basic fundamentals of the inflation profile, which shows a sharp fall in inflation in 2023, are still in place. A 50 basis point increase will be one of the options on the table, of course, for today. But 50 basis point is not guaranteed. And anyone who predicts this is doing this based on their own opinion. So, other than that, to add, so again, just cautioning that, yep, it is one thing to, as an option, it's there, but it'll be silly enough to try and, think that could happen. So, the Bank of England could be open to doing a 25 basis point hike instead, maybe, right? Of course, there are possibilities for anything to happen at a rate decision. Which makes it a reason, another reason as to why you should watch interest rate decisions when they come out. Bailey said that if we see signs of greater persistence of inflation and price wage settings are such signs, we will have to act forcefully. So he said that about, of course, as with inflation and also with price pressures too. And just reaffirming that they could do a 50 basis point hike today. But bearing in mind, this will be the biggest rate hike in 27 years from the Bank of England, that they would have done a 50 basis point hike. So it'll be a very significant move in itself anyway, although the markets have been pricing it in. So if you're thinking of, the Bank of England maybe doing a 75 basis point hike, which has never been mentioned by the Bank of England ever, and if you're looking out for that could be, that's seen as highly unlikely, as said, considering the last time a 50 basis point hike that was done, it was done 27 years ago. So 50 basis point hike being the biggest one so far. And then other areas too, let's have a look at some of the other comments then from Bank of England members. So July 18th, you had Saunders said that I don't think we're done yet on rate hikes, and it's not correct to say that the neutral rate is 1%. It is higher. So of course we're looking for a higher rate of interest, and that's if markets are looking for 3%, for the interest rate to be 3% by the end of the year, then some could say that the neutral rate could be around, could be around 1.5% or 2%. Similarly to the Federal Reserve and also the Bank of England, but the Bank of England hasn't really given any clarification as to where the neutral rate could be or should be. So more or less leaving it to traders to kind of define where the neutral rate of interest should be. Then on July 14th, you had Bank of England's Ramsden said it is very likely that interest rates will have to go up further. Pill also said that I'm willing to move faster on rates if required. So of course, looking for a 50 basis point hike maybe, rather than doing a 25 basis point hike. Being a Bank of England's man, or one of the people who were looking for a 50 basis point hike at the last meeting, said that the decision maker panel survey, or from the Bank of England, shows that firms' pricing expectations are well above the 2% inflation target. So businesses are expecting a continued high rates of inflation that's going to linger for longer than expected. And then on July 5th, you had Tenrero, who is one of the members who's expected to look for a 25, who's expected to look for a 25 basis point hike rather than 50 basis point hike. And Haskell is also one of those members too. So that tackling inflation early would have hurt jobs. So if they were to, of course, raise rates much sooner back in, let's say if they wanted to do it in November, then that would have, in Tenrero's eyes, would have damaged the economy. Of course, if you damage the amount of jobs, and that hurts the economy, then that of course means there's less money in people's pockets to be able to spend if they don't have anything coming into their account. So Tenrero being one of the dovish members still one of the dovish members of the Bank of England. I say Haskell also said that the BV is determined to meet the CPI target of 2%, and we won't wimp out. So he's also expected to be one of the members, as said, to look for a 25 basis point hike rather than a 50 basis point hike. But that's one of the things just to be aware of. Also, Pill on prices wage costs. So the current challenge for UK monetary policy is to contain those second round effects and return inflation to target. And June 20th, you had Bank of England's man who said that a 50 base point move reduces risk of domestic inflation being boosted by a weaker sterling. So of course, whenever you raise interest rates, that raises the value of the currency. Okay, because you have traders that will flock to a higher rate of interest compared to maybe their own domestic currency, particularly in the short-term environment, or not comparing it to the long term. When interest rates do rise, then you usually see an appreciation, or the expectation for rate rises or rate being increased. You see an appreciation in that currency. So that's just something to be aware of course, if you're unsure of why, when interest rates are raised, why the currency goes higher. But again, just to clarify, when you do see interest rates being raised and it's as expected, sometimes, as I said, you'll see a blip reaction where it'll be short-lived. So you might see a jump up quickly and then jump down, or vice versa. And then the markets just kind of carry on with the way that they were trading beforehand. So this is something just to, again, as I said, this will be the first half-point hike for 27 years. You can see in the past then, so just an image from a Bloomberg article that I found. So when Margaret Thatcher became Prime Minister, you'd seen that when inflation was high, the central bank rate was also quite high as well. And when there are other issues as well, so with the Eurozone, you had the ERM crisis as well, with the currency, whether or not to peg the pound to the euro, or take on the euro, altogether. There's also that issue there, and then you can just see overall that, again, clear thing just to make everyone understand, is that when inflation is high, more or less the central bank's rate is more or less in line with inflation. Now, this is a different story altogether. We're at 9.4% in the UK for CPI year on year. So does that mean that the Bank of England's interest rate has got to reach that much? Well, we don't know yet. But historically, you can see that it has more or less tried to match inflation on a couple of occasions. But here, we've got a very big disparity, or there's this big gap between where inflation is or where the Bank of England's rate is at the moment. So it could mean that, if they are looking for inflation to start moving further down, or start moving down in 2023, then maybe they don't really have to go any higher than possibly if we were, looking at 5% as an idea, right? If they were to reach it as like the very, very highest point. That's one potential scenario. But if inflation continues to tick up, then you could see that rate of interest go higher to try and dampen inflation. And then we're in real trouble in the UK, because if inflation becomes unanchored and gets out of control, traders will lose faith in the currency and it will lose its value, and traders will look to other currencies elsewhere instead to try and jump on a higher rate of interest where the currency isn't devalued, because the central bank isn't credible enough, or has lost credibility because they've lost the fight against inflation. But from what we've seen in the past, that hasn't really happened. The Bank of England has, taken steps to rein in inflation as best they can. So they've kind of retained their credibility to that degree there. Of course, you can see market implied Bank of England rate looking at, hovering around that 3% area there. All right, so investment bank views then. So we've got about 9 minutes left. I'll quickly go through this. Credit aggregate, say the PMI data this week, the survey or the services PMI, still relatively robust, along with stronger CPI of late. It may suggest the MPC would adopt a somewhat less pessimistic stance on the economy. UBS saying the Eurozone and UK both likely to face energy and supply shortages this winter if the crisis in Ukraine continues and Russia continues to utilize energy exports to put pressure on Western countries. The political scenario in the UK is also a big issue too. Of course, we're waiting for the Prime Minister to be elected by September 5th, and that's causing some uncertainty. Until we get a Prime Minister elected, then you'll be able to see a bit more volatility creeping back into the pound, and you'll be able to see some more bigger moves. But at the moment, everything's a bit more choppy. Nobody's kind of sure who's going to be Prime Minister, whether it's going to be Rishi Sunak or Liz Truss, and there's different things that are going to affect the UK and what they want to do. So that's one thing to be aware of and cautious of, is that there might not be as much volatility as there usually is when there isn't an upcoming election. So analysts expect a 7-2 vote for a 50 basis point hike, with Cunliffe and Tenrera as the dissenters. So that's what I was saying, that UBS expecting a 7-2 vote for a 50 basis point hike. The average estimate, or the median estimate from the other economists, is 9 for everyone to look for a 50 basis point hike. But UBS saying that it's actually going to be a 7-2 split. And so market pricing also suggested that there is a 75% probability of 50 basis point hike as well. And that was at the beginning of the week. And of course, so again, that's quite a big gap. Still 25% is, it's when we're basically saying we're not out of the neck of the woods yet of sticking to a 50 basis point hike. Commerzbank say UK's long-standing problem of falling productivity and the incoming UK administration is taking over in a tough scenario, as according to Ulrich Luchtmann, head of currency strategy at Commerzbank, saying the risk of a terrible spiral of rising inflation and a lower currency is always present. So there's also those factors that the bank are going to have to take into consideration too. If there's a loss in productivity or drop off in productivity, that of course is going to reduce the GDP figure, and in turn is going to mean that people are going to have a less their living, the way that they live is going to be less favorable, or it's going to be much worse if GDP isn't as strong, or if they're not being as productive, and there'll be more debt that people have to pay back if they've borrowed a lot of money, or they might not be able to pay that debt at all if they have no job. Credit aggregators see a 25 basis point hike, along with Citi and Credit Suisse, Goldman Sachs and JP Morgan, with the rest of the other economists too, or the median forecast, are looking for a 50 basis point hike. But the reason why I've put these here is just to make you aware that you do have investment banks that are expecting or are looking at a 25 basis point hike at the meeting. So this is what we have here. So this is it's unchanged from the last time that we had the rates. So you can still see Saunders, Mann, and Haskell, which were the hawkish members from last time. But it's quite interesting that one of the members, it should be Cunliffe, not Haskell, one of the dovish members there that wouldn't be in favor on a 50 basis point hike. But it's quite interesting that they said UBS had said Haskell. But yes, so that was unchanged from last time. We've got about 5 minutes. So let's play the video. Let's go here. It's about 3 seconds before the release comes out. So you see that there is the 25 basis point hike as expected. Remember, you had the central banks, or you had the FMC yesterday or the day before that were that did a 75 basis point hike, which is bigger than the expected 50 basis point hike. The Swiss National Bank and some of the other central banks, like the minor ones like Saudis and Omanis, had taken their rate hikes after the Federal Reserve did. And the S&B, which had kept rates or hadn't hiked rates in 7 years, had decided to do a 50 basis point hike, still in the negative at minus 0.25%. But it was a big move, or a big enough reaction from the Swiss National Bank to the FMC. But the Bank of England didn't do that. So they're more or less traders were expecting a 50. So 50 is like a surprise hike, but they didn't. They said we're going to stick with a 25 basis point hike. That's why the pound had gone down, and you can see that evidently there. Now, I'll quickly go through the deviations. We don't have too long left. I just close that there, move out of the way. All right, deviations. So key thing to remember is when the rate is as expected, and when markets aren't, looking for a bigger rate hike, then you more or less see flat movements occurring. Okay, so sometimes there'll be comments that will come through that could cause the pound can go down, or maybe one of the voters. So you see here, Cunliffe was one of the voters last time who wanted the rates to be unchanged, that caused the pound to go down. But when it is priced in already, you don't really see. You see more or less a whipsaw on the initial reaction, and then the currency is flat, and then you start to see you see the currency just continuing its movement prior or heading in the opposite direction because it's been priced in. Okay, but if you do get if we do get a 25 base point hike today, right, then you could see some really strong movement towards the downside from cable, because not everyone is expecting a 25 base point hike. That's very small at the moment. Median estimate is for 50. So if you do get a 25 base point hike, when the Bank of England said that they will raise rates, or when they said they'll be more aggressive if need be, and they do a 25 base point hike, you'd see a depreciation in sterling if there's a 25 base point hike instead. 75 base point hike, a much bigger than expected rate hike, would see some appreciation towards the upside in sterling. But okay, we've got about a minute left now. So key thing is, if the rate hike is as expected, not expecting too much of a reaction, maybe it's a more or less minimal volatility from the market itself, from sterling. Okay. Okay, so hopefully we've got about 30 seconds left, or about 20 seconds on my side. 14. Just gonna zoom all the way up. Okay. All right. Not too long left. Hike, 50 base point hike, 50 base point hike to 1.75%, in line with the expectation for a 50 base point hike to 1.75%. Also from what we see here. So again, as I said, there was a whipsaw reaction. You see a little bit of a pop, and then you see a movement towards the downside. And it looks like everyone voted for a 50 base point hike. So there were no dissenters at the Bank of England there. But even as said, it's not holding on to its initial move towards the upside. Looking at some of the figures then, so they'll set gilt auctions schedule every quarter. You have markets imply more tightening than May, show bank rate at 2.4% in the fourth quarter of 2022, 2.9% in the fourth quarter 2023, 2.4% in the fourth quarter of 2024. So higher than expected rate hikes rates where the expected rate is to be in the future. Oh, right. So Tenrero voted to raise rates by 0.25% to 1.5%. So she was the dissenter there. So Bank of England policymakers voted 8-1 to raise the bank rate to 1.75%. Okay, so let's do some quick measurements then on here. Have a look at cable. So as we'd seen that initial move towards the upside, that little pop. So there's about 40 pips towards the upside there on cable. And then let's do some more measurement. We'd seen it's about 9.5 pips down after that decision, where the candle had with the bottom or the wick towards the downside. We look at Euro GBP. So we go from 22.5, and then start the candle. That's about 10.5 pips up. All right. Okay. And that did nada. All right. If I look at somewhere else, if I look at GPJPY, look, see what that did. Right, there we go. All right. Oops. Okay, so that was about 53.5 pips, or 53.8 pips towards the upside there initially, and then if we look where we are now, where it was on the bottom wick, so similarly, it's a very small move towards the downside there. Okay. All right. So, yeah, like I said, now we've seen the reverse happen of the news coming out. So you'd seen that initial pop towards the upside. And so as I said, markets had already priced it in. A bit of a pop towards the upside. And then now it's moving the opposite direction here. Alrighty, ladies and gentlemen, thank you very much. Oh, I've missed a lot of comments from you guys. Let's see. There's a ton here from you guys. Good morning. No sound. Right around 122. Trying to see what else we got here. So there we go. Somebody said Dixie should go down. Rate hike. Here we come. Great insight. Thank you very much. Somebody said, Bear Bob said, hello, sir. Second time here. Thanks for hosting. If I'm speaking, the audio is not working. Oh, yes. I was just away from the desk for a little bit. All right. Okay. So, somebody's saying, why is GBP going down? Interesting. Well, I kind of just said it. So, I'll go over it again though. So whenever the rate hike is priced in, then you'll see that you'll have, as I said, it'll be more or less treated as like buy the rumor, sell the news. So the rate decision comes out, there's a bit of a pop, and then it kind of just sells off. So that anyone who had their position, or had an open position, or was buying up the pound or sterling before the rate decision, and they've seen the data come in, you'd seen their little pop, and then they sell their positions, and then that's it. Then it starts to head further down. But don't forget. So if you've enjoyed this stream here, so apologies for the sound issues at the beginning, but don't forget to sign up to FinancialJuice Pro, where of course you get the data, and you also get to see the headlines that come through as well here, as you can see there, for the comments from the Bank of England, and then also the market reactions as well. You also get to see that in real time too. So don't forget you can sign up to FinancialJuice Pro. If you're already using FinancialJuice, if you're on the live version, you can get a 7-day free trial of that, where you get no adverts, no delays. Everything is in real time as well. That's voice and the text and the economic releases, and also the economic triggers here as well. So if I wanted to set an economic trigger for a release, then I can set my buy and sell alerts here at whatever I want it to be. So just ignore this number where it says 1.75%. That's just the forecast figure. Okay. You set that wherever you want to set it. That'll come up with a little bell here. And when the figure matches your expectation, matches your figures that you've put in, it'll either show you a buy or sell sign immediately as soon as the data comes out to the site. So that's also in real time too, whereas in the live version, that'll be delayed. So the 7-day free trial is, I've popped it there for you. You can have a little look at it. I've pinned that message too in the chat for you to have a look at. Now, of course, if you're also interested in tick strike, so tick strike, allows you to listen to order flow and the amount of momentum that there is behind asset classes, of particular instruments. That's to do with stocks, ETFs, ETNs, currencies, futures, everything to do with futures, bonds, of course, bond futures, cryptocurrency too. That's another thing that Tick Strike covers as well, which is that you can have a little play with and use. So I've put in the 7-day free trial of Tick Strike there as well. That'll give you a bit more of an insight as to what to expect from how to use Tick Strike and what it does. But the key thing to remember is it allows you to listen to and look at the momentum on the little ticker that will appear, usually appears on the screen here or wherever you want it to appear. So that's Tick Strike. Of course, if you like Macro Race, then give us a follow on Twitter, Twitter Macro Race on there _ You can have a look at there, show us your support there. Also, don't forget to like and share this video too with your fellow traders. If you are saying that, if you like this video, show us your support, give us some love. So that's Macro Race's Twitter. And of course, for macro race itself. Now, if you want more insight into what to expect, i.e. for the rest of the week or the week ahead, the releases that we'll be covering, the deviations too, that you can look at with a bit more time. And then you can sign up to the mailing list of macro race. So you can have a look at the deviations with more time on hand. And you can see, and you can also see that the week ahead for not only for the European session, the US and Asia session as well, and also the weekend news that I usually kind of do anyway, because I'm addicted to news and I can't get away from it. So that's something that is also provided with Macro Ace as a service. Also, do let us know if you already are a subscriber to the mailing list and you've seen the emails. Let me know of anything that you want me to improve on or change or get rid of or add to the service. Also, and then finally, you can also sign up to our beta product that we have at the moment, our beta testing group for unusual activity. Now, it is a product that we've had in the past, but this is more considered like a relaunch. So if you like trading unusual volume activity in stocks, then you can join the free beta test group of the new service, and that's here as a link. There you go. So if you love trading stocks, of course, we have the US session coming up pretty soon. So 9:30 in the morning. You'll be able to have a little play with that and see how it helps you, of course, identify stocks that are seeing unusual amounts of volatility and volume. All right, so that's macro race. So tomorrow we have non-farm payrolls. It's a big dog day tomorrow. And what I'll do is I'll put out the link for you in this chat if you're already on here. So then you can join me for tomorrow. And that'll be at 7:45 a.m. Eastern time. Now, at the same time of the non-farm payrolls for the US data, we're also getting the Canadian employment data as well at the same time. So more or less, they're more or less the same thing. So you don't, there's no real difference, of course, just which country we're covering. But that is the link to the non-farm payrolls release for tomorrow. Alongside, that's also going to include the Canadian employment change data as well. All right. Thank you very much, ladies and gentlemen. I will see you tomorrow. But for now, take care and goodbye.